The 2026 credit reality check. Imagine waking up on January 1st, 2026. You have zero credit score, no credit cards, no loans, maybe just a little past debt, and a financial record that barely qualifies you for approval anywhere. The headlines are screaming about rising interest rates, economic uncertainty, and lenders tightening credit approvals. Most people freeze right here. They assume the system is rigged, so they don't even try to rebuild. But if I had to start from absolute zero right now, knowing what I know about credit cycles, scoring behavior, and dispute strategies, I wouldn't panic. In fact, I would argue that 2026 is actually a cleaner entry point to rebuild credit than we've seen in years, if you ignore the noise. The strategy I'm about to lay out isn't about quick fixes. It is the mathematical path to your first 700 credit score and eventually excellent credit, specifically designed for the current lending environment. It starts with a number most people are terrified to look at: your current credit report. Before we open the spreadsheet, I need to make a deal with you. I'm going to break this down into 4 phases: the audit, the elimination, the reporting rebuild, and the optimization. This is a complete roadmap. There's no course to buy. The only cost of admission is your attention. If you want to treat this channel like a peer review session for credit strategy, go ahead and subscribe. I aim to give you the highest return on your time when it comes to credit repair. The credit debt trap. If I am starting at zero, the first thing I have to address isn't opening a new card. It's the invisible anchors dragging my score down. I call this the negative reporting trap. It is usually disguised as old collections, late payments, or high balances. The credit myth. There is a pervasive myth that you can rebuild credit by just applying for new cards or loans. I see people all the time asking if they should get a secured card or a small loan while they still have unpaid collections. They think, if I pay the collection later, the new account will fix my score. This is the credit equivalent of trying to fill a bucket that has holes. If I am starting fresh, I have to accept that my score isn't zero. It is negative. And until I fix that, applying for new credit is off limits. Mathematically, paying off or settling high-impact negative items is a guaranteed improvement in score. You cannot get that guaranteed improvement anywhere else. The numbers don't lie. Say you have $2, 500 in collections, or charge-offs dragging your score below 600. If you ignore them and only open a new card, your score may barely budge over the next year. Meanwhile, if you clear or dispute those negatives using proper methods, your score can jump 70, 120 points in months. That's the difference between approval and denial. In 2026, with credit scoring models constantly updating, the impact of old negatives is real. Every unpaid or misreported account is a point you cannot recover unless you act strategically. The psychological cost: we keep bad credit around because it feels manageable. It is just a number on a report. We normalize it. But psychologically, negative items create a scarcity mindset. You hesitate to apply for loans. You hesitate to request credit limit increases. You avoid financial risks. The true cost isn't just the points lost. It is the opportunity cost of the financial freedom you are too scared to take. Phase 1. The audit. The protocol is simple. List every single negative item from highest impact to lowest. Ignore balances or age initially. Focus on what damages your score the most: collections, charge-offs, late payments. This is the avalanche method. Throw every spare resource at the highest impact item while monitoring the rest. Negotiate settlements, validate reporting errors, and remove inaccuracies. Phase 2. Build the emergency buffer. Once high impact negatives are addressed, don't rush to apply for new credit. Why? Because life happens. Unexpected medical bills, car repairs, or missed rent can put you back into negatives. We need a buffer. A small cash reserve prevents emergencies from undoing your progress. Phase 3. Rebuild reporting. Now that the deck is cleared, It's time to rebuild positive reporting. Secured cards, credit builder loans, and authorized user accounts are tools here. The key: small balances, paid on time, reported consistently. We aren't chasing high limits. We are building proof of reliability. Phase 4. Optimization. Once positive accounts are reporting consistently, optimize your score. Lower utilization below 10%. Diversify credit types slowly. Monitor for errors monthly. Use dispute strategies to correct lingering negatives. Automate payments to prevent accidental late reporting. The skill audit. Improving credit isn't just financial, it's also about mastering the tools, knowing reporting cycles, and understanding the scoring logic. Spend 1 hour a day learning credit law, dispute methods, and reporting timing. Apply those skills and your score improves faster than just paying bills. The 2026 Credit Rebuild Roadmap. If I woke up in 2026 with zero credit, audit all negative items, tackle high-impact accounts first. Build a 3-month emergency buffer to protect against setbacks. Rebuild reporting using secured cards or credit builder loans. Optimize accounts for utilization, age, and mix. Master credit strategies to increase leverage and maintain long-term growth. It isn't sexy, it isn't a quick fix, but it is a guaranteed path to excellent credit. I've run the numbers many ways, and they always point back to these fundamentals. Credit repair is personal. Maybe you have a different approach, but this roadmap gives a mathematical framework for rebuilding from zero. Drop your strategies in the comments. I read them to see what I might be missing. And if you found value in this breakdown, consider subscribing. It helps me keep the content coming. Thanks for watching, and I'll see you in the next one.